Okay. In this question, we are required to calculate how many units of A double nine A needed to be produced. So we need to calculate the budgeted production unit. We have already determined or learned this formula. Budgeted production unit is equal to budgeted sales unit plus closing stock of units minus opening stock of units. Okay. So now we will calculate budgeted production units by using this formula. Opening inventory is 14,000 and closing inventory is reduced by 40%. It means closing stock or closing inventory will be 60% of it 14,000. So we can calculate that what would be this 60% of 14,000, 8,400. So according to this formula, sales units are 100,000 plus closing inventory is 14,000. Sorry, closing inventory is 8,400 minus opening inventory is 14,000. So we have an answer of 94,400. What is the formula to calculate production, the budgeted production? Sales plus closing inventory minus opening inventory. So B is the right answer. This is the formula which we used in the last MCQ. A process has a normal loss of 10% and the budgeted output is 4,500 liters. It is output for the period. Opening inventory of the raw material is 600 liters and is expected to increase by 20% by the end of the period. What is the material usage? Material usage is basically 4,500 which we use for the output, but we have a loss of 10%. That's why we entered 100%, but we achieved output of 90%. So that's why our material usage is 5,000. Or we can also say that our material input is 5,000. Here we have an input of 5,000 kg. Sorry, 5,000 liters. What is the formula to calculate budgeted material usage? Budgeted material usage is equal to material usage per unit multiplied with budgeted production unit. So budgeted production unit or the production budget multiplied with standard material quantity per unit. So A is the right answer. A company has a budget of 2 products, A and B. Sales units, production units are provided. Labor rate per hour is provided. Hours per unit is provided. What is the budgeted cost for unskilled labor for the production or for the period? So now we have how many units? We have 1750 production units for sale. Each unskilled labor needs 3 hours and rate per hour is 7. For B, we have budget production unit of 5,000. Hours are unskilled hours are 4 and the rate is 7. So we can calculate the value 1750 into 3 into $7. It is $36,750 and then 5,000 units at $2 into 7, so it is 140,000. So So the sum is $176,750. C is the right answer. What would be the principal budget factor for a football retailer? Principal budget factor means what? It means limiting factor. It means a country is unable to meet its maximum demand due to limitation of resources. This limitation of resource could be labor hours per unit. This limitation of resource could be material usage or material availability of raw material. This limitation of resources could be machine hours. So this is called what? This is called limiting factor. The cost item taking the largest share of the total expenditure, it is not principal budget factor. Product line contributing the largest amount to sales revenue, no. Product line contributing the largest amount to business profit, no. The constraint, limiting factor, that is expected to limit the retailer's activity during the budget period, this is called what? This is called principal budget factor or limiting factor. A company makes two products X and Y which are sold in the ratio of 1:2. 1:2 means we will sell 1 unit of X plus we will sell 2 units of Y. It means we are selling one package. In package we are selling total 2 units in combination of 1 plus 2. It is not possible to sell X without Y and it is not possible to sell Y without X. The selling price are $50 and $100 respectively. Company wants to earn $100,000 over the next period. What should be the sales budget? Okay. So the company wants to earn what? Company wants to earn 100,000. And we are saying that we are selling products in one package or in one packet. In one package we have 1 unit of that which has a selling price of $50. So 50 into 1, we have a package where Y has 2 units, 2 into 100, so it's 250. Now we can divide this 100,000 by 250. We calculate what? We calculate number of packets or number of batches. We have 400,000 packets or batches. Now it is divided, we have 400. Now it is divided what? Now it is divided into 2, into X and Y. For X we have just 1 unit. So 1 is multiplied by 400 packets. For 400 batches it's 400. And Y has 2 into 40 into 400 is 800. So the correct answer is what? Correct answer is B. A business is preparing its production budget, material usage and material purchases budget for the forthcoming period. The following information is known: budgeted sales, closing inventory for the finished goods, and required closing inventory of the finished goods. This one is current inventory of finished goods and required closing. So we can treat it as the opening stock or opening inventory. Okay. Each unit of the product uses 6 kg of material X and the rates for this area are as follows. Current inventory of X is 2000, required closing inventory of X is 600, 2600. Now, if this information is relevant with the material and this information is relevant with the output or units, you can say it is better to say it is relevant with the unit because unit has one of the components which is called material. Apart from material, we have labor, we have variable overhead. All these components are part of the unit as well. What is the production volume required for the forthcoming to meet the budgeted sales demand? Required production volume to meet the forthcoming sales demand. We have already learned the formula that budgeted sales is 2300 plus closing inventory, which is 550, minus opening inventory, which is 400. So we can say 2450 is the required production to meet the sales demand. So this is the required production volume. A company makes two products X, Y, and Z. The following information is as follows. X, Y, and Z, budgeted production units 300, 400, 300. Machine hours per unit are 5, 6, and 2. Variable overheads are 2.3 and fixed overheads are 0.75 machine hours. So he says that what is the total overhead budget? Total overhead budget means what? Variable overhead plus fixed overhead. So X is equal to 200 into 5. Y is equal to 400 into 6. That is equal to 300 into 2. So the sum is 4,000 hours. Now variable overheads are 2.3 into 4,000 plus fixed overheads 0.75 into 4,000. 9,200 variable overhead plus 2,000 is fixed overhead. So the sum is 12,200. Who is the right answer? Clear? Next question he says that what is the total direct material usage? Material usage is equal to what? Or total direct material usage is equal to what? Budgeted material usage per unit into budgeted production unit. So for this product, we have budgeted material usage of 2, and for this product, we have a budgeted material usage of 1. Multiply with budgeted production units. Budgeted production units are not provided, but sales, opening stock, and closing stock is provided. And similarly, we have sales, opening stock, and closing stock. So we can calculate production units for both the departments, for both the products. Plot work line is equal to sales plus closing inventory minus opening inventory. It's 450 into 2. It is 920 kg. And for wind up train, it's 550 plus 40 minus 50. So the 540 is budgeted production units. Multiplied with budgeted usage 1. So the answer is 540 kg. So we can add up both the kg. 920 plus 540. 1460 kg is the right answer. This is budgeted material usage. What is the material purchases budget? Material purchases budget is equal to budgeted material usage plus closing stock of raw material minus opening stock of raw material. So we have already determined budgeted material usage for both the products 920 and 540, and we are provided with the closing inventory and opening inventory as well. So the total material usage is 1450 plus closing inventory of 50 minus opening inventory of 50. So first of all, we will calculate how much material is needed to purchase. We need to purchase 1470 into what? Into material price per kg. Price per kg is what? Price per kg is $5 per kg. So you can multiply it with $5. 1470 multiplied with $5 is 73. $50 is material purchases. Then we have total labor budget. In dollar means total labor cost budget. So we will calculate budgeted labor hours. Budgeted labor hours are basically 18 minutes for this product and 30 minutes for this product. And budgeted production units, we have already determined that 460 units are needed for one product and 540 units are needed for another product. We have 18 minutes and 30 minutes. So first of all, we will calculate labor hour. 15 by 16 into 920, 30 by 60 into 540. Sorry, here we have 460 units. 9 kg, 920 was the usage. And then we have how many units? We have 540 units. So we can calculate number of hours. What would be the number of hours? In first equation we have 138 hours, and in the second product we have total 270 hours. Sum is 408. Per hour rate is provided in the question, which is $8. So we can multiply both the values. 32, 64 is the total direct labor cost budget. Any question? Okay. A job requires 2400 actual labor hours. Actual labor hours means productive hours. For completion, but it is anticipated that idle time will be 20% of the total time required. It means actual hours are 80%. Total hours are 100%. This 100% is combination of productive hours, which is 80% here, and 20% idle time. Maybe in any other question, situation will be different. If the wages rate is $10 per hour, what is the budgeted labor cost for the job, including the cost of idle time? So we have budgeted actual hours of 2400 or productive hours of 2400. First of all, we will calculate total idle hours is equal to idle hours percentage, which is 20, divided by productive hours percentage, which is 80. 2400 hours of productive hours, and we are calculating what? we are calculating idle hours out of this productive hours percentage. So idle hours are 600. Now you can calculate your total hours 2400 plus idle hours 600, total hours are 3000. And rate per hour is $10, so you can multiply your 3000 hours with $10 and you will get the answer of $30,000, which is option D. Any question? Okay. What is the continuous budget? Continuous budget is basically a rolling budget. Continuous budget is the one where we prepare more than one budget in one accounting period. Maybe we are preparing monthly budget, so it means we will prepare 12 budgets. Maybe we are preparing quarterly budget, it means we are preparing 4 budgets. Or maybe we will prepare just 3 budgets, 6 months each. Prepare in advance for the period in question. Definitely budgets are prepared in advance. Updated regularly by adding further periods, which means if we are following quarterly budget, we prepared 4 budgets: quarter 1, quarter 2, quarter 3, quarter 4. At the end of first quarter, we have actual results of quarter 1. Now that quarter 1 is ended, we will prepare budget for next 2 quarters: quarter 2, quarter 3, quarter 4, and quarter 1 for the next year. So updated regularly by adding further period. After quarter 2, you will cross this quarter, Q3, Q4, Q1, and next year Q2. Also known as rolling budget, it is correct. Always prepared for a full year in advance, not prepared for the full year in advance. So A is the right answer. Any questions? Now we have questions related with the cash budget. He is preparing the cash budget for July. His credit sales are as follows. How much may Vincent expect to collect from credit customers during July? April is $40,000, May is $30,000, June is $20,000, July is $25,000, and he is saying that credit sales are 20%, current month sales 20%, prior month sales 60%, sales 2 months prior 10%, and maybe coverable debts are 5%. So if we are talking about July sales are 25,000. So current month sales 25,000 into 20%, which means 5,000. Prior month was June, and for June we have sales of 20,000. So 60% of this 20,000, 12,000. 2 months prior means May. So 30,000 into 10% is 3,000. And 5% are irrecoverable debt. There will be no calculation of irrecoverable debt. You can add these values. Total sum is 20,000, and B is the right answer. This is the cash collection for the month of July. When he says DRF projected revenue for 20X9 is $88,000 per month, all sales are credit, receivables accounts are settled 5% in the month of sales. So half will pay in the month of sales, 40% in the next month, following means next, subsequent means next, and 5% are written off, which means bad debts, as the recoverable debts after the 2 months. What is the budgeted cash collection for March? So first of all, we have 50% at the end of month for 28,000. It's 14,000. And then in the same month, we will receive 45% of 28,000, which is 12,600. So the cash collection for each month is 26,600. Why cash collection is same in the each month? Because our pays are same in each month, $28,000 per month. That's why we will receive 50% at the end of same month and 45% in the next month and 5% as backup. Then we have a company anticipates that 10,000 units of product that will be sold during January. Each unit requires 2 liters of raw material W. So it is what it is budgeted material usage. Actual stock as 1st January and budgeted inventory of 31st are as follows. If the company pays for all purchases in the month of acquisition, what is the cash outlay for January purchases of W? Cash outlay means cash payment. First of all, we will calculate purchases. We are talking about the raw material. So, we are talking about that. To calculate purchases, we need what? We need budgeted material usage, which is not provided in the question, plus closing stock of raw material. Closing stock is 15,000 minus opening stock of raw material, which is 20,000. Now to calculate budgeted material usage, we need what? We need budgeted usage per unit into budgeted production unit. Now units are not provided in the question. So to calculate budgeted production units, we will follow the formula sales 10,000 plus closing stock of 12,000 minus opening stock of 14,000. So we have budgeted production units of 8,000. Now we can calculate what? We can calculate budgeted material usage. 2 into 8,000, it is 16,000. So now you can calculate purchases, budgeted material usage, plus closing stock of material minus opening stock of material. We have 11,000 as budgeted material usage. Now he is asking us to calculate in value terms. So the amount for each liter is $4. So 11,000 into 4, we have $44,000 as the cost of material purchases, right? Any question? Okay. Next question is, the company has 2 months receivable cycle, 2 months receivable cycle. It means if I will sell goods in this month, in the month of May 2023, I will receive after 2 months. It receives 45% cash as the total gross value in the month of invoicing. Wherever you see percentage, you can assume is a dollar value. That we received $45 of the total gross value, and assume that total gross sales value is $100. Irrecoverable debts are 20% of the total gross value, and there is a 10% discount for settling accounts within 30 days. So we receive 45% with the same monthly within 30 days. 45% of gross after deducting this discount. So we can say what? We received $45, which is 90% against what? The total amount which we received in the month, in the same month. So the total amount in the same month is 100 by 90. It is $50. Out of what? Out of the total gross value of 100. Out of this 100, we receive 45 after giving a discount of $5 from this $50. Now he says that your bad debt is 20%. So the 20% of $100 is what? It is $20. What next? What is the remaining or received as cash in the second month? 100 minus 50 minus 20. So the 30 is receivable. We can calculate 30 by 100 into 100. 30%. B is the right answer. Any question? Okay. Next we have year based gross sales is 40% per month. Same question, gross. Which is 10 of which 10% is cash. So out of 40,000 we have received 10% cash, which means 4,000. So the receivables is what? Receivable is 40,000 minus 4,000, it's 36,000. Experience shows that credit sales are received as follows. Receivables paying within one month of what? Of this receivables amount of $36,000. Within 2 months, 50% and 4% is the settlement discount payable within 1 month. So 36,000 into 0.4 into 0.96, which means out of this 40% there will be a discount of 4%, and we will receive what? We will receive net value of 13,824. So out of 36,000 we have received 40% in the same month, and out of this 40% we received 96% after deducting this 4% discount. Remaining 50% are receivables in the next month. So 36,000 into 0.5, 18,000. Sum is what? Sum is 35,824. This is the total expected cash received in any month. A is the right answer. Sales figures from a budget for the next month are as follows. Sales are 450,000. Gross profit is 30%. So you can calculate 30% of this sales. It is 135,000. So it means remaining amount is what? Remaining amount is cost of sales. You can deduct 135,000 from this 450,000, 315,000. Decrease in payables over the month. Over the month means what? Closing balance. It is the closing balance. Opening balance, sorry, it is opening balance. Decrease means opening balance was 10,000 and now it has reduced by $10,000, which means now closing balance is what? Closing balance is 0. Increase in inventory held over the month. So it is now closing balance 18,000 and opening balance of the inventory was 0. So whatever balance is not provided in the question, that will be credited or considered as what? 0. Credited payables. Now what is credited payables? Payables is equal to opening payables 10,000 plus credit purchases which are not provided minus cash paid So we will say or minus payables, which is 0, is equal to what? Cash paid during the period, or payment to cash paid. You can say that cash to paid payables. Now we will calculate our purchases. To calculate purchases, we will this cost of sales. Cost of sales says what? Opening inventory, which is 0, plus purchases missing, minus closing inventory 18,000, and cost of sales is what? Cost of sales is 315,000 as cost of sales. This is the formula which you learned in your earlier studies as well, or in the profit and loss. So now to calculate this value, we will add that because 18,000 is deducted, it is 333,000. Opening inventory is 0, so it means purchases are 333,000. To calculate cash to trade payables, opening payables 10,000 plus credit purchases 333 minus closing is 0. So what is the right answer? Right answer is 343,000. So this is the right answer. Any question? Okay. Next question is again regarding the cash balance. A company has current cash balance of $7,000, total receivables 15,000, and trade receivables of 40,000. Company sells goods costing 50,000 for $70,000 next month. We are concerned with the costing for purchases and sales for the receivables. One half of the sales are corrected in the month of sale. It means out of 70,000, we have received 50%, 35,000, and 35,000 are still receivable. And remainder in the following month means in the next month. All purchases are made on credit and paid during the following month. So we will pay the stable amount of 40,000 in the next month. Inventory levels will remain constant during the month. General cash expenses will be $60,000 during the month. What is the cash balance? So we have cash received. First of all, we will receive 15,000 from the receivables. We received 35,000 from the current month. We paid to our supplier for 40,000, and we paid for the general cash expenses of 60,000. So we are in negative with 50,000. It is called net cash flow plus opening balance 7,000. So 43,000 is negative, which is called cash overdrawn. This is the right answer. Any questions? When we have, because the following would not be included in the cash budget, depreciation is a non-cash item, depreciation will not be included in the cash budget, and provision, it is a provision, not the debt. So these are not included in the cash. Now you can solve the next one, that is the payment to supplier, and hopefully the next one as well. Budgeted production overhead for the April and May is as follows. For the April, it is $93,000. For May, it is $87,000. One third of the production overhead is paid, including depreciation of production machinery of $8,000 per month. So these are the overheads. First of all, you will calculate what is the proportion of fixed out of 93,000. And you will also subtract the fixed cost of 8,000. You can calculate value. It will be 20,000. Yes. May, for same for the month of May, here we have 31,000 minus it. Payment of the variable production overhead expenditure are 50% in the month they are incurred. Okay, so variable out of 92,000 is what? Variable out of 93,000 is 2 by 3, which means 52,000. It is cash variable cost or variable overhead. It is cash fixed overhead. 50% in the following months in which they are incurred. Okay. Payment of fixed production overheads are made in the months following that in which they are incurred. How much would be shown in the cash budget for May in respect of payment for fixed production overhead and variable? Payment of fixed production overheads are made in the month following that in which they are incurred. So for the month of April, fixed cost of 23,000 is payable in the month of May. So 23,000 is provided in two options. It means B and B are excluded. Now we are saying that for variable overhead, we will pay 50% in the same month and 50% in the next month. So from the April, we received 50%, which is 31,000. And now we can calculate from this 87,000, that what would be 2 by 3 of this 87,000, or 1 by 3, which is 7,000 into 2 by 3. This is this variable is 87,000 into 2 by 3, which is 58,000, and we will pay 50% in the same month, which means 29,000. So for variable overhead, we will pay in the month of May 31,000 from April and 29,000 from the May. So it means 60,000 is the total payable amount with respect to variable overhead, which means option A is the right answer. Any questions?